Let's read an obituary of the last 49 months today on The Logistics Life. Hey there, my friends. Ooh, what a dramatic intro, eh, Dean? Was that a good one or what, buddy? When you just said that to me off air, where you're like, Dan, I think it's the obituary of the last 49 months. I'm like, oh, I think that's what the title is going to be today. So depending on when y'all are watching or listening to this, the 49-month obituary is going to be the title. Dean, how are you this morning, brother?
Yeah, good, Dad. Good to be with you. Not too far from you, actually, and in Buffalo today.
I know. And how long are you in Buffalo for?
Just a day. I got a conference with a big brokerage here, LDI, and then over to Minneapolis tonight for a presentation with US Bank. So it's kind of a quick 3-day trip.
Nice. Well, US Bank, talk to me. What is the presentation that you're going to do for US Bank?
It's for US Bank. It's for the shippers, right, that use their freight payment system. So US Bank is sort of a big freight payment operation. Bit like CAS is for those more familiar with the
Okay. When you were saying U.S. Bank, I'm thinking the banking industry. I'm like, what? That would be interesting to make that comparison to logistics, wouldn't it? I mean, like,
so they got a bunch of shippers in, but anyway.
Okay, so yes, I'm so interested in our obituary for the 49-month, Dean. Been really tough for a lot of people, like call a spade, right? I know there's a lot of negativity out there, and I don't necessarily want to be negative at all, but I do think we need to be real, right? So I see what we've been through. I believe it to be, and I know some people are going to agree, some people are just going to disagree. So for all those watching and listening, I understand the fact that depending on what market you're in, right? Like if we look back at the pandemic, those that were in, markets that delivered goods to us soared. Those that were in markets that were just importing stuff maybe didn't soar so much, right? So call a spade a spade. I look at the last while and the negativity in the market and the challenges people have faced. And, again, yesterday, more reports of people going out of business. And not only that, I'm also noticing, and it might be something for another show, but I'm also noticing a lot more corruption, a lot, and even internally in companies, like companies double leasing trucks and trailers and triple leasing and triple financing, and all these things are starting to happen. I think just to give themselves a little more runway, thinking to themselves, well, if I can just get through this period, I'll make it all right in the future. And often that leads to Ponzi schemes, but I really want to know about this 49-month obituary, Dean. So what are we talking about? What's the outlook? Let's dive right into it.
So this has been a roller coaster ride. When you look at the charts of rate movement, year-over-year rate movement, it's literally a roller coaster. But the length of the freight cycle's been getting longer, and the amplitude was off the charts going up and then off the charts going down in terms of what the pandemic did to the industry. So I don't know that this is the new norm, but up until this cycle, and remember this cycle I'm looking at from, the middle of 2020 when the pandemic really took hold to 2 months ago. And we call it a freight recession. We measure it from when spot rates go year over year negative to when they go year over year positive, right? And they've just gone year over year positive for 2 months in a row now. So we've kind of got a trend emerging, but it was 49 months, right, from when it started to when it finished, this freight recessionary cycle that we've just seen. Prior to that, 2012, 2016, 2019, that was 17 to 20 months from start to finish, right? This one's been a really long freight cycle because we had 22 months of really aggressive expansion. So rates were going up year over year for 22 months, Dan, almost 2 years, up until March, April 2022 from 2020, right? And then we've had 27 months of contraction. Like, think about that, 27 months of going down and no daylight. like nothing on the horizon that says things are going to turn anytime soon. So on the show here, we've been talking a lot about spot rates bottoming out. It's a long trough that we're in. There's no real signs of any freight demand trigger that's going to move the needle. Capacity still exiting the market. And it's still, and it just accelerated again in the spot market in July and August. So it's just seen another exodus of small carriers. We just started to see some bankruptcies of bigger fleets. Jason Miller had a report out this week where he's seeing not necessarily the number of companies leave as being a trigger, but the size of the companies are decreasing. Right, so they're getting rid of trucks. They're cutting back on the number of trucks, which of course makes sense. So what we're seeing is this freight market that's searching for equilibrium as capacity continues to exit, right? It's trying to find the bottom where supply meets demand. Problem is our manufacturing numbers are pretty anemic and kind of moving sideways. There's no real upturn in manufacturing numbers. So we've got this market where it's kind of bottoming out, but then there are signs though that the market is starting to lift itself off the bottom. Right. And one of the ways we look at that is the year-over-year change in spot rates. So this week, my boss, Ken Adamo, had a post out on LinkedIn. And these are his words. He said the early obituary of this current cycle from June 20 to June 2024 is 49 months. We've just had year-over-year positive rates. And I'll read you the numbers. In dry van, year-over-year positive rates are about 3% up year-over-year. So they were down for the best part of 27 months. Now they've turned positive. It's not a quick crossover though. Normally, if you think about when spot rates come back up year over year, there's kind of an X shape to it where it crosses contract rates, because contract rates lag. So
Yes.
they can still be dropping as, right? But they're tracking each other very closely. So what it means is we're still not seeing any significant upward movement in the underlying rate that says, hey, this market has really turned. It's turning, but very slowly is how I would describe it. So we've seen 2 months of positive year-over-year rates. That's a great sign. And that should continue, albeit some sort of a disaster. But I think we're in pretty good shape with seasonality. Imports are going to keep coming in. We've got some higher freight volumes from some of the seasonal trends we're seeing. So I think like with produce and fall produce, Christmas tree season, all those sorts of things that normally happen, we'll start to see rates lift off the bottom. So that's where we are right now, but it's a 49-month cycle of up 22 months, down 27. And I think that's where you started the show talking about how much pain people have been through. And it's not that we didn't realize rates would come down. I don't think a lot of us realized for how long it would take because of the excess capacity.
So, Dean, and I'd love to get your thoughts on this because something hit me probably, almost a week ago. It was just after our last show. And I started thinking of the freight cycles when I first got into the industry, right? And kind of the tenure of the median that I see most people. So that median that I'm seeing, and don't get me wrong, there's always, variables outside, but it's kind of 7 to 9 year median. And what I'm saying is the people that I'm noticing, that are out in the market, if I will say. So you see their posts, you have conversations with them, they're at golf tournaments, it's that 7 to 10 year is the major majority. And the one thing that kind of hit me is what's happened in the last 7 to 10 years. Okay. So I look at this and I say, okay, so we had 18 to 19. So we had 17 to 18, 18 to 19, which was the huge spike and then drop, right? And if we look at the way that happened, 17 going into 18, everything was kind of growing. And then ELD hit and the mandate. And it was this almost like a 90-degree vertical climb, right? And then 2019 hit and it was like this 90-degree vertical drop.
Yeah.
Then 2020, and it was this 90-degree vertical increase because of COVID.
Right.
And then it in 2022, it felt like this 90-degree vertical drop.
Yep.
So if you've been in the freight market for that period of time, you're almost programmed to believe the market is not eggshelled. It's like a spike, but it's not. Because even if we go back to the 2009 fallout, 08, 09, right? And we start looking at that. And then you go back even further when the Canadian US exchange started to change dramatically. And then you go back even further than that. And so there's these cycles. But if you, and I would love to see the data comparison if you have it, because I think this would help a lot of people really get a different perspective, right? So those were eggshells, right? Like 2008, there was a fall off that was happening before the market crashed. Right. And then, but if you've only been in the industry, 7 to 10 years, you're used to the massive spikes and the massive decreases. And I'm wondering if, and this, sorry, long way around to get to your thoughts here.
Yeah.
But I'm wondering if a lot of people have this comparison in their head. So prospectively, it doesn't make sense, where really this is the way a normal freight cycle would work, is eggshells on both sides, up and down. Does that make sense?
Yep. Well, it's kind of this, it's a bit like recency bias, right? Where, our bias favors the most recent events over historic ones. It's kind of like this memory. And I think, Dan, the other point though, is a lot of people in the freight industry, this is their first freight cycle. Think about all of the massive amounts of hiring that went on, because I make the mistake, we all make the mistake of assuming everyone in brokerage or transportation knows the industry, knows 2008, 2009. No, think about the pandemic era. We had the number of carriers in the market double from when the pandemic started. And 20% of those carriers that joined are still operating today. So this is their only freight cycle they've seen. Those, 20% of the people that joined during the pandemic that are still here. So this is a brutal cycle for them on the way up and the way down. If they've survived this, heck, they're in pretty good shape, because I think those left standing are actually in really good shape. And I think that's what we underestimate. If you've been through $5.80 a gallon, it's now down to $3.55 a gallon today. If you've been from, $5 a mile, money falling from the sky, to $2 a mile today, if you've survived that, you've got something good going on. Now, on the brokerage side, I would say the same thing. If you figured out how to manage that cycle, you're in pretty good shape. But most people, though, in the industry, with the exception of some veterans like us, don't remember the 08, the Great Recession. We had the highest number of trucks produced ever in factories in 2006. Right, so that's kind of led to the oversupply of trucks and that great cycle you alluded to. We had, the market was improving for 2000.
The major HOS change.
Yep.
Right. Remember that when that happened, when the hours of service changed, that was like, I remember some stats. I forget where I saw them, but it was almost like overnight Walmart needed 6,000 new drivers just to complete their supply chain.
Yeah.
And the big concern was, where are we getting these drivers? There's been a lot of turmoil, right?
In 20 years, absolutely. And don't forget, telematics has grown exponentially. So the data has grown exponentially. At the same time as the record number of trucks, we had the digital age start when the iPhone came out. So suddenly you've seen this curve of tech come into the market, where we've seen all this transparency. All these new carriers can come in and see the entire market on an app on their phone.
Yes.
On our DAT1 app, you can put all your operating costs into the app, and it'll tell you about the bid from the broker and how viable that load's going to be. That sort of stuff is fairly new in the last few years, where the barriers to entry are much lower. Doesn't mean the risk isn't there, but it's much easier to get into this industry and make a go of it, because I think we're far more adaptive to change. We can move quickly now because the data is almost instant. You could watch this podcast, you could watch my IQ show, you could listen to a podcast, and suddenly you'll pick up something and say, oh, I didn't realize, Christmas trees start shipping, 3 weeks before Thanksgiving. I didn't realize that. Or I didn't realize fall produce is about to start up in Pendleton and the Yakima Valley. And so there's tons of things going on right now that if you're in tune with the market, I think this is still a pretty good time in the market. But I think the underlying thing here is that we've still got a lot of capacity in the market, and it's what we talked about last week. It's the latent capacity that's opportunistic. It'll come into the market when demand surges, and it'll go out of the market when it falls. It's not like they're there permanently, and that's why it's different to 2019 freight cycle. the 18-19 cycle.
Yes.
Normally you have this sort of, rising tide lifts all boats, not in this freight cycle, because, and this is what my talk will be at US Bank and LDI today, is that there's some extraordinary things going on because we now have a large and growing cohort of independent contractors who own all their own equipment because of the heady days of the pandemic when they were making 100 grand a year during that 21 period. So they can then, if line haul rates in dry van are at $1.60 today, excluding fuel, bare bones, your operating costs are about that right now, like including a 60 grand salary. So if you're a broker and bidding a lane and you're trying to bid the carrier down, they're not going to tell you that. But a lot of carriers can get by on really low rates today. Now, if they've got a fuel surcharge, it's more like $1.99, $2 a mile. Like if you think about the all-in rate, that's an incredibly good rate in this market if your operating costs are down around $1.60, right? So I think for a lot of small carriers, they're getting by, but we're still seeing the fallout of carriers that entered late in the cycle that paid triple for a used truck, who have a finance contract, who probably need $2.10 a mile to run. They're the ones that are really treading water and starting to exit the market. And I talked to Todd Amon at ATBS a few weeks ago, and he said this has been a really rough period for a lot of carriers, the summer, because we had fairly soft volumes. Like rates did move up a little bit, but volumes were relatively soft for, a typically good second quarter, which is normally when shipping volumes start to move the needle. We had a really soft summer in the spot market in particular, largely because we had tender acceptance rates in the 95 to 96% range. So it mean, what I mean by that is that carriers, large carriers, are accepting 96% of the loads shippers send to them, which means that your second carrier, the second most expensive carrier in your routing guide, is not seeing much of the fallout. Now, in normal times, that rejection rate is more like 12 to 15%. And as loads fall down and carriers reject them, they work their way into the spot market. So we're seeing less spot market volume, higher routing guide compliance. Bigger carriers are accepting more of those loads. They're sort of historically low rejection rates. So I think and what that's done is the carriers in the spot market have said, heck, not a lot of volume in the spot market. Rates are still flat, bottoming out. And of course, at the end of June, if you look at the exits in July and August, the end of June, a lot of the quarterly payments are due, tax, a lot of your big bills come due sort of every quarter. So I think there's a lot of people that just exited the market, but we've seen a big exodus. I can give you some numbers if you're interested in what this looks like.
100%, yes.
Yeah, we had, so remember, this is about 3% of total carriers, the, 12 to 15,000, but the rate of interstate carriers entering the market also surged in August, but it also surged for exits. But the net was we still lost carriers. So we had more leave than join. So this is a really interesting dynamic in this small part of the spot market where most of the capacity movement is. We're still seeing more leave than join. So, but it's sort of like when you look at the net, we're still not back into the growing capacity phase. We're still leaking capacity at a really slow rate, because you would think in this crappy market, what are you joining for? Like, what are you getting an authority and what are you hauling? To my earlier point, if you come into the market and you've got a relatively well-priced used truck and rates are around $2 a mile, that's not a horrible market. If it's at the bottom and you're thinking this thing's going to take off.
Well, I think, would you not think it would be, and to put it kind of more on a baseline conversation, almost like investing?
Yeah.
The stocks are down. Eventually it is going to turn. Yeah. So do you wait until somebody, call it a stock. So call it, opening a company or getting a CVOR or MC, running authorities, is a stock. You wait till it's at the lowest. Yep. It is a very low cost of entry,
right?
Which is the opposite of what happened during the pandemic. It's a low cost of entry, and you look at it and you say, okay, well, I got a runway of 6 to 7 months.
Right.
I got a low cost of entry. Let's just build it over. And because I do believe, going back to what you said at the beginning, I think any company that survives this on a good note. So,
Mhm.
you know, as a broker, it's good team,
Mhm.
good structure, good systems,
Mhm.
good suppliers,
Mhm.
right? Those are your 4 top criteria,
Yep.
right? And probably 5 would be business that is profitable,
Yep.
obviously, because you don't want to move freight at a loss. And then as a carrier, same thing, right? Like your suppliers, meaning your customers, are they good? And
Yep.
if you're in that boat right now, when this market turns, I do believe those people get catapulted, kind of like buying
Right.
stocks at a really low value,
Right.
and
Right.
all of a sudden they turn.
Yep.
Right? Like, I mean, I remember when the pandemic hit, I got bank stocks at one point, and they skyrocketed after, because they all just fell, and it was like I happened to be there at the right time, and they skyrocketed, and it was
Yeah.
great.
I
But
think you're right.
yeah, and I think that, you know, that might be some of the mentality of people coming in, where they're willing to take a chance, right?
Well, it's
For
also
lack of a
peak
better
season.
term.
It's peak
Yeah.
shipping season, right? So if you were thinking about it and you're going to join in June or July, you'd be thinking, well, this is normally when we see peak shipping season in the second quarter. The getting's going to be good. We've just seen the LMI report come out where inventories have been run down, and then they're starting to build, right? So we had a couple of months of inventories being run down as they, you know, people positioned back to school and all that sort of retail summer stock. Inventories are now starting to build back up again in readiness for the retail season. So if you think that through, you could say, yeah, the getting's going to be good all the way through till Christmas here, right? But then after Christmas, then you start to see that really slow quarter.
Yeah.
So I think there's carriers out there that are looking at this from an opportunistic viewpoint. But I think even if demand improves, and we will see some volume surges around the seasonal events like Black Friday, you know, Thanksgiving, Christmas, all those sorts of things.
Yeah, Cyber Monday and all that.
And capacity will jump into the market when there's demand, and then they'll park up when it's quiet. These independent contractors I've been talking about. So what you'll see is that rates, I think, will remain fairly flat, because even with the demand surge, when that opportunistic capacity jumps in, it keeps a lid on things. Right? Because what's not happening is a net capacity out of the market, because we've now got a lot more profitable independent contractors in the market. Right. So that's why I think you're going to see rates fairly flat through the end of the year, albeit there'll be some ups and downs over various weeks. The other point, Dan, is we've had a really quiet hurricane season. You know, they had
We
record
really
levels
have,
of dust.
Like,
They had big levels of dust off Northern Africa. Dust really belts down the wind shear and stops that conveyor belt of storms. We've seen a couple pop up. There's one in the Gulf now. The data point that really got my attention from Everstream Analytics yesterday was, this is the calm before the storm. Be careful, because 40% of tropical storms and hurricanes happen after today.
Oh, okay. Because my
We're
next question to you is going to be, because I know FEMA and everybody put out statements saying it was supposed to be the worst year ever for hurricanes
right.
and tropical storms, but we haven't really seen any that have been monumental,
But it's
right?
only mid-season. We're only mid-season. So, you know, Dan, I hope they are profoundly wrong with their forecast, like, because we don't want that really. But
No.
this is one thing that I think, you know, we saw it with Road Check Week, Brake Check Week. Whenever you have a big event, capacity, you know, when capacity in the spot market steps out for a short period of time, what it means is that any major event will cause a snap in spot rates.
Yeah.
Right. So
But it didn't really
week,
move much when we, like, even Road Check Week and all that, and Brake Check Week and everything. If I remember correctly, now correct me if I'm wrong, Dean, but if I remember, the rates didn't move even close to what they would normally move.
Well, rates went up 12 cents during Road Check and then came down. They're up about half that during Brake Check Week, but it was also end of month, end of quarter, and Labor Day.
Yeah. Okay.
Right. So it's hard to say that Brake Check Week, but carriers still take time off, and that still moves the needle. So my point is, though, that it won't take much of a shock to the market, in particular any of those hurricanes and storms that come through the Gulf, Houston Gulf, gasoline alley, where all our chemical and refineries are. That will cause a fairly big disruption. not just from a freight perspective, but for our diesel supplies. So, Dan, diesel just hit 355 last night, the national average, lowest in 3 years. So there's some crazy stuff going on in the market where diesel's down about 22% in the last year. That's another tailwind for carriers joining the market because their operating costs are just coming down and down and down. Now, rates have been coming down and down also, which affects their top line revenue more so than anything. But this is going to be, my prediction for rates is fairly flat through the end of the year because of this incredibly misunderstood concept of latent capacity. I think you're always going to see these carriers now jump in and jump out of the market when there's the surge. That doesn't mean every lane's going to have an excess of capacity when you need it. I think if you're in the brokerage market, it's going to be a little bit more nuanced than that. You're going to see very tight capacity on some lanes. But things are improving. I think that's the good news. I saw that the jobs report came in last week, a little bit worse than expected. A couple of the Fed board members here said it's time to drop interest rates in the September meeting here. If that happens, they didn't telegraph how much they wanted to drop interest rates, but they're adamant that interest rates would drop, which of course will be a stimulus to economic activity and capital spending on projects that, more freight to haul. So I think that's a really important catalyst. The big gorilla in the room, of course, the 800-pound gorilla is the election. And of course, everybody has been sort of sitting on a lot of decisions, I think, until they see which way things are going to fall out there, whether they've got to deal with a trade war or more regulations, depending on, what administration remains in power.
So and again, there's obviously, we get much different views in Canada than you do in the US, obviously. But I don't see this election cycle as bad as the 2016 one.
Correct.
Right. I think because, and again, maybe this, and obviously not a political show, Dean, but I think it's because we understand both parties better now.
Yeah.
Right. And that, again, just my perspective for what it's worth. But I know 2016 was a crazy year for freight when there was no idea what was going to happen. Right. And then all the tariffs and all the talks, and there seems to be less of that this cycle. Right. Probably because the US, the NAFTA was redone. There was a lot of things redone. Right. But yeah, I do agree, and I do see that.
We had Tim Denoyer on our show yesterday talking about new truck orders, and it was very interesting because he said the order books haven't opened yet for new truck orders. They open in September, October, which of course has some tax advantages if you're ordering new trucks in this calendar year. But think about oversupply. People have been thinking about pre-buying trucks ahead of the 2027 regulation. Big carriers are still trying to find equilibrium with the right number of trucks for loads. So I think if you had to say what data points should I watch in the next few months, the really big tell I think will be probably October's new truck orders, because that's going to tell you where fleets think the market's headed next year.